Give us your top line out of your earnings. What should we be taking away from it?
Yeah, David, first, thank you for hosting me again. It's always a pleasure to visit with you. The second quarter was exactly what we said it would be. During our first quarter earnings call, we said the second quarter was shaping up to be one where we would have to spend some investment to recover the network. And in the bottom half of April, at the very beginning of the quarter, we got very congested. And in order to dig out of that, we had to control inventory on the railroad, and we had to include some excess costs in the railroad to recover. Both of those happened, and we showed recovery during the quarter. Our key service KPIs improved from April to June pretty substantially. So that we could position ourselves well in the back half of the year. So that's all done. That meant we did grow. We had good revenue number. We grew operating income, grew EPS, but we had excess costs in the network, and we didn't collect all of the volume that we could have, and that compressed our margins during the quarter.
So, Lance, that sounds pretty encouraging. At the same time, we talked to a lot of people who are concerned about a softening in the economy. It turned out maybe even a recession coming down the pike. Are you seeing any evidence of that?
Yeah, I've talked to a lot of our customers, David, and the ones that are multinational see a lot of concern in Europe, certainly in China, and then they look back into the United States and they see markers that say things are going to get soft, like consumer sentiment's not good, consumers are starting to draw down their purchasing habits a little bit, convert some of that goods buying to experience buying. But the jobs market's still strong, wages are growing, and consumers are sitting on a lot of money. And for us as a railroad, we're just not seeing the weakness bleed over into us. Mostly, I think it's about unique things that we experience in our markets, like, for the agricultural markets, grain, feed, other product, food and refrigerated. It's a strong market. For coal, natural gas pricing is driving demand. For metals, minerals, some of the industrial chemicals, plastics, we're winning business in the marketplace. So it's not clear to me that if the U.S. goes into a recession and slowdown continues further, that it really visits fully on Union Pacific.
Lance, tell us about rail service. I know that it dropped off with the pandemic. I saw that it improved some in April. You're still not back to pre-pandemic levels. When do you think you'll be able to get there?
Yeah, we're not back to normal yet, David, and we'll get there in the third and into the fourth quarter. Normal for us is a car velocity, a freight car velocity that's 200 plus miles a day. It's getting our terminal dwell, keeping it at about 23 hours. Right now it's a 23 and a half, 24. We got a little work there. And just making sure that we're fluid. When our customers are happy, you'll see it both in our freight car velocity, our dwell, our train size, and in our overall volumes.
Tell us about your workforce, because a lot of employers are having trouble keeping, hiring and keeping employees. What's your situation with respect to your workforce?
Yeah, well, the good news is our attrition and our retention rates look like they have, on average over the last 5 years. So we're not seeing a significant impact there. We did have a hell of a time trying to hire what we were looking for, call it in the back half of last year and the very early part of this year. Our classes now for hiring are full, and we're being able to hire mostly where we need new employees. And the difficulty that we were having, David, was in states and in locations that had exceptionally low unemployment, like Nebraska, Iowa, Wyoming. Those areas were pretty difficult, although now we are starting to fill our classes and graduating full classes.
And where are you with organized labor? What kind of union contracts do you have coming up?
Yeah, so we're late in the process of our national negotiation. We're really about 2.5 years into it. I'm disappointed we weren't able to reach agreement before now. But the news came out earlier that the president appointed a presidential emergency board. That's normal course of business in our industry. It happens periodically. That board is staffed with 3 arbitrators. They're professionals, they're experienced. And what happens next, starting Sunday, management presents their case and what we think is reasonable to that board. The labor unions do the same. And then the board comes up with what they think is a reasonable compromise. And that forms a foundation that we can negotiate an agreement on. If we don't do that, 30 days after they release their report, then there could be a strike or a lockout. I don't think that happens. I think Congress imposes the deal on us.